You glance at the financial news lately,
Hmm.
and, well, some headlines really grab you.
Hmm.
And one that really jumped out at me is this. The U.S. dollar index, the DXY, right? It saw its worst two-month slide since way back in 2002.
That's a long time.
Yeah, this was just March and April of 2025.
Yeah.
At the same time, gold prices, they've been absolutely on a tear, record high.
Over 3,300 an ounce, wasn't it? Mid-April.
Exactly. $3,326.60 on April 16th.
Mm.
So it really makes you stop and think, what is going on with the dollar and gold? And, what could that actually mean for, well, for you?
Yeah, and maybe even longer term, could this dip signal something bigger
Yeah.
about the global landscape?
Precisely. That's what we want to dig into today.
Okay, so this deep dive, we're focusing on that relationship, which is often pretty fascinating, sometimes even predictable, between the U.S. dollar and precious metals, gold and silver mainly.
Right.
And what our sources are showing pretty consistently is this kind of historical seesaw effect. Typically, a stronger dollar tends to push down on metal prices, whereas a weaker dollar, like we're seeing right now with the DXY, it tends to give them a lift.
Right. So we've pulled together info from places like APMEX, Investopedia, Bullion Exchanges, plus some recent news snippets to really unpack it all.
Good range of sources.
And the key thing for you listening is that understanding this dynamic isn't just for, Wall Street types. It can give you some really valuable perspective for your own investments maybe, or just understanding the broader economy.
Yeah, the goal is to kind of distill the main points so you can grasp the core drivers without getting totally bogged down in jargon.
Exactly.
So let's start with that basic idea, the inverse relationship. Why does a weaker dollar generally mean higher gold and silver prices?
Okay. Yeah, why is that?
Well, the main reason is that precious metals, they're priced globally in US dollars. That's the standard.
Okay, so unpack that a bit.
Yeah.
If the dollar gets stronger, what does that actually do to the cost for someone buying gold, say, in Europe or Japan?
Right. So a stronger dollar makes those dollar price metals more expensive for someone holding euros or yen or whatever.
Okay.
It's like, if the exchange rate suddenly swings against you when you're buying something online from overseas, it just costs you more in your own currency.
Right.
And that higher cost, well, it tends to dampen the overall demand for the metals. And when demand softens,
Prices usually follow.
yeah, prices tend to follow. Exactly.
Got it. So logically, the reverse should be true too?
Precisely. When the dollar weakens, suddenly gold and silver look cheaper to those international buyers.
More attractive.
Yeah, that lower price point makes them more attractive. Demand tends to pick up, and generally, you see prices start to move upwards.
Are there clear historical examples of this? Sometimes seeing it play out really helps cement the idea.
Oh, absolutely. Think back, early 1980s, the Fed was hiking rates like crazy, fighting inflation.
Right, Volcker era.
Exactly.
Yeah.
That led to a really strong dollar. And what happened to gold? It actually fell quite a bit from its earlier highs. Then, fast forward to, say, the 2008 financial crisis. Big problems in the U.S. economy, lots of monetary easing. The dollar weakened substantially.
And gold.
Gold soared, hit new record highs. Investors were scrambling for a safe haven.
Interesting. And I did see a stat that kind of stuck with me historically. A 1% drop in the DXY, the dollar index, has correlated with almost a 1.8% increase in gold prices.
Yeah, that suggests a pretty sensitive relationship, doesn't it?
It does.
It highlights that strong historical tendency. But, it's crucial to remember correlation isn't causation, right? There are always other factors moving markets.
Oh, sure.
Still, that statistic gives you a good feel for just how responsive gold can be to dollar swings.
Now, another thing the sources kept coming back to was the dollar status, the world's reserve currency.
Yeah.
Why is that global role so important when we talk about gold and silver?
Well, that reserve status gives the dollar this sort of outsized influence on global finance. And that definitely includes precious metals. It just means that most international trade, most big financial transactions, they happen in U.S. dollars.
Right.
So when the dollar's value moves, it sends ripples, everywhere, across the whole global economy.
So how does that ripple effect specifically hit commodities like gold?
Because so many key commodities, metals included, are priced in dollars, any big dollar move has these widespread effects. For countries using other currencies, a stronger dollar means they need more of their own money to buy the same amount of, say, gold or oil.
Which can reduce their demand.
Exactly. It naturally puts downward pressure on demand from those countries.
And if the dollar weakens, then
Then the opposite happens. Those commodities become relatively cheaper for international buyers, potentially boosting demand. And there's another layer, too. During uncertain times, a weaker dollar can sometimes make precious metals seem even more appealing as a safe haven globally.
right, a store of value outside the potentially weakening dollar.
Precisely.
Our sources also mention central banks holding dollar reserves. How does that fit in? It's kind of like countries having a big savings account in U.S. dollars, isn't it?
That's actually a pretty good analogy, yeah. Central banks hold huge amounts of dollar reserves. They use them for international trade, managing their own currencies, acting as a buffer against shocks.
Yeah.
And this widespread holding, this acceptance of the dollar, creates this sort of baseline demand for it, which helps underpin its strength globally.
Okay, so we've got the historical inverse link, the dollar's big global role. Let's zoom in on right now. We kicked off mentioning those big DXY drops in March and April 2025. What are some reasons why the dollar might be weakening so much recently?
Yeah, the data is pretty stark, over 4% down in April after more than 3% in March. That's definitely a notable slide. Our sources point to a few things. One is investor sentiment.
Okay.
Apparently, a Bank of America survey showed a lot of pessimism among fund managers about U.S. assets. A big chunk, over 60%, expected the dollar to weaken even further.
Wow, that's quite a consensus or lack of confidence, I guess. What else?
Another factor that came up was the potential fallout from President Trump's tariff policies.
How would that weaken the dollar?
The thinking is these policies, the trade tensions they create, might be making foreign investors a bit nervous, maybe causing them to reduce their holdings of U.S. assets. Less demand for dollar assets could, contribute to the dollar weakening.
Interesting. So maybe a mix of sentiment and policy effects kind of swirling around. Okay, so how is this dollar weakness then playing out in the metals market? Gold, obviously the big story. That huge surge, what's driving that specifically?
Right. That climb past $3,300 an ounce for gold, it really looks like a combination, a confluence of factors, all sort of linked to that softer dollar.
Like what?
First, there's the classic flight to safety, increased investor demand for safe haven assets. When the dollar looks shaky, investors often look to gold as something more stable.
Makes sense.
We've also seen reportedly increased buying from central banks recently. That adds another layer of demand. And finally, there's the expectation, or maybe the hope, of future interest rate cuts from the Fed. Lower rates can make gold more attractive because it lowers the opportunity cost of holding an asset that doesn't pay interest.
Right. If cash isn't earning much, gold looks relatively better.
Exactly. Especially if inflation is still a concern, even if it's moderating. That idea of negative real rates.
And what about silver and the other metals?
Mm.
They usually move with gold, don't they? Or is it more complicated?
Generally, yes. Silver often tracks gold. And it has seen gains, too, adding about 0.5% recently to around $32.45. But silver's performance wasn't quite as dramatic as gold's.
Why the difference, maybe?
Well, silver has that dual role, right? It's a precious metal, but also a key industrial metal. So its price can be pulled around by industrial demand factors, too, which makes it a bit more complex sometimes than gold.
And platinum, palladium.
They've been more mixed, according to the reports. They're heavily tied to the auto industry catalytic converters. So things like car sales, emissions rules, they play a huge part there, sometimes leading them down a different path than gold or silver.
Okay, so not just a simple dollar down, all metals up story. Important nuance. Stepping back a bit, what are some of the wider economic ripples from this weaker dollar and the gold rally?
Well, we are seeing more volatility in the stock market, and this dollar weakness seems to be happening alongside that.
Yeah.
Probably investors are reassessing risks, with trade issues, general economic uncertainty kind of hanging in the air.
Any potential upsides to a weaker dollar, economically speaking?
Potentially, yes.
Right.
For emerging market economies, it can be a bit of a relief. Makes their dollar-denominated debt easier to handle.
Oh, okay.
And it can also boost the value of the commodities they export, since many are priced in dollars.
And for the U.S. itself?
Yeah.
Any advantages?
Yeah, a weaker dollar can make American goods and services cheaper for buyers overseas. So potentially, it could help boost U.S. exports, give those export-focused industries a bit of an edge.
Okay, so the dollar's value, clearly a massive piece of the gold price puzzle. But it's not the only piece, right? What else really moves the needle for gold, even if the dollar is stable?
Oh, absolutely correct. The dollar is huge, but other factors are definitely critical. Let's talk supply, mining production.
Okay.
Unlike, printing money, the amount of new gold mined each year is actually pretty small compared to all the gold that already exists above ground.
Right. The existing stock is vast.
Exactly. So that inherent scarcity makes gold prices often quite sensitive to shifts in demand or investor mood, sometimes more so than shifts in actual mining output.
And mining itself has challenges.
Oh, yeah. Things like environmental rules, rising costs to extract gold from harder to reach places that can make new projects tougher, maybe limiting future supply growth. And of course, where the gold comes from matters. Countries like China, South Africa, the US, they're major players.
Makes sense. Scarcity drives value. What about the central banks? We mentioned they're buying, but how big is their overall influence?
They are really significant players, huge. Collectively, central banks hold something like 1/5 of all the gold ever mined.
Wow.
So their decisions, buying or selling, can definitely move the market, not just directly through supply and demand, but also by signaling confidence or maybe lack of confidence in gold as a reserve asset.
And are they all doing the same thing?
Not necessarily, but there has been a trend, especially among emerging market central banks, to increase their gold holdings. It's often seen as part of a strategy to diversify their reserves, maybe move away slightly from relying solely on the US dollar.
Interesting. So strategic diversification, not just investment. Okay, now you touched on this, but let's dive a bit deeper into inflation and interest rates versus gold.
Right. So historically, gold is often seen as that inflation hedge, and it tends to have an inverse relationship with interest rates.
Because of opportunity cost again.
Exactly. Lower rates mean you're giving up less potential income by holding gold, which pays nothing. So it looks relatively more attractive. And especially when real interest rates are negative, meaning inflation is higher than the interest rate you can get, gold often shines. People want to preserve purchasing power.
But you mentioned something interesting earlier, that recently gold's been rising even as inflation and rates might be moderating.
Yeah, that's the intriguing part of the current mid-2020s environment. Gold's continued strength, even as those factors maybe ease off a bit, it suggests other drivers, like maybe the safe haven demand or central bank buying, are really powerful right now.
Which brings us neatly to maybe the most classic reason people buy gold, that safe haven aspect, hedging against uncertainty.
Exactly. When markets get turbulent or there's geopolitical tension or an economic crisis looms, gold often acts as that port in the storm.
Why gold specifically?
Well, it has this incredibly long history as a store of value. Plus, its price often doesn't move in lockstep with stocks or bonds. It has a low correlation. That makes it appealing when other investments feel risky. It's kind of like portfolio insurance for scary times.
And it's become much easier for regular investors to buy gold now, hasn't it, with ETFs?
Oh, absolutely. Gold exchange traded funds, the big ones like SPDR Gold Shares, ticker GLD, or the lower cost GLDM, they've really revolutionized things.
Hope so.
They make it super easy for anyone, big institutions or individual investors, to get exposure to gold prices without needing to, buy gold bars, figure out storage, insurance.
Right. None of the physical hassle.
Exactly. And when people buy shares in these ETFs, the fund usually goes out and buys actual physical gold to back those shares. So it creates a direct link between investor money flowing in and demand for physical gold.
And these are big funds.
Huge. As of early 2025, GLD and GLDM together held over 31 million ounces of gold. That's worth, what, over $90 billion? Massive scale.
Is it important to know what these ETFs hold?
Yes, very important distinction. Those big ones, GLD, GLDM, they hold physical gold bullion. But some other gold ETFs actually invest in the stocks of gold mining companies.
Ah, so you're betting on the companies, not the metal itself directly.
Right. And mining stocks can perform quite differently from the gold price itself due to company management, operational issues, costs, leverage. So different risk profile. Definitely something listeners should check if they're considering an ETF.
Good point. Okay, one last demand factor.
Yeah.
What about just people buying stuff?
Yeah.
Like jewelry. Does that still matter much?
It certainly does. Consumer demand, especially jewelry, has traditionally been the single biggest chunk of annual gold use. Around half, historically.
Really? Still that much?
Yeah. It's heavily influenced by culture and economics, especially in huge markets like India and China. There, gold jewelry isn't just adornment, it's a traditional store of wealth, crucial for weddings, festivals. Now, industrial use, like in electronics, that demand is growing and maybe more stable. But yeah, jewelry remains a massive part of the overall gold demand picture.
Okay, so for someone listening, trying to kind of synthesize all this for their own financial thinking, What are the key things to watch right now? Any potential strategies to consider in this environment?
Well, staying informed is absolutely key. Keep an eye on those main economic indicators we talked about: GDP growth, jobs numbers, inflation rates like the CPI. They give clues about the dollar's likely path.
And central banks.
Definitely. Watch central bank policies very closely, especially the Fed interest rate decisions, what they say in their meeting minutes. That's critical. And, geopolitical events, too, they can spark big, sudden moves.
Any tools or approaches people can use?
Sure. Using financial platforms, websites, apps that give you real-time exchange rates, market analysis, that can be really helpful. Some investors use technical analysis, looking at charts, trends, trying to spot potential turning point.
Okay.
And, the basics still apply. Diversification, it's always smart to have assets that might do well even if the dollar strengthens. Balance is key.
What about hedging or getting more specific exposure?
Right, for international investments, maybe look into currency hedging. And if you really want to lean into gold, besides physical metal or the bullion ETFs, you could look at gold mining stocks or ETFs that hold those miners, like SGDJ, the Sprott Junior Gold Miners ETF. That can offer leveraged exposure, but also comes with extra risk.
Those are some really concrete, actionable ideas.
Yeah.
But it's also vital to keep the long view, isn't it? Gold isn't always the hero asset.
That is such a critical point, yes. While gold can be a fantastic hedge in certain conditions, historically, over the very long run, its returns haven't always kept pace with equities, especially during strong economic growth periods.
Like that comparison you sometimes see.
Right, like if you invested $100 in gold back in, say, 1972 versus $100 in the S&P 500 index. Both would have grown, but the S&P 500 investment would likely be worth substantially more today.
So gold has a role, but maybe not as your primary growth engine always.
Exactly. It's about understanding its strategic role within a wider, balanced portfolio.
Okay, so let's try and wrap this up. For you, the listener, what are the main takeaways from this deep dive on the dollar and metals?
I think the fundamental point is that historical tendency, the inverse relationship between the US dollar and metals like gold and silver. Right now, we're seeing dollar weakness, likely due to sentiment, maybe policy effects.
And that's helping fuel the gold
So
rally.
a big contributor, yes.
Yeah.
Alongside that, safe haven demand, central bank buying, maybe rate cut expectations, it's a mix.
And why does this matter to our listener?
Because understanding these connections, these dynamics, it gives you a really valuable lens, a framework for interpreting the economic news you see every day, and for thinking about your own financial situation, your investments.
Yeah, it shows how interconnected everything is.
It really does. And it underlines why it's so important to keep learning, keep monitoring these key factors. They don't stand still.
Definitely. So finally, maybe a provocative thought for everyone to chew on. With all the chatter these days about potential alternative reserve currencies, you hear about the BRICS nations maybe trying to challenge the dollar's dominance, even if that's still pretty speculative right now.
Right? Lots of talk, long way to go, maybe.
But how might that kind of long-term shift potentially affect this historical inverse relationship between the dollar and precious metals down the road?
Ooh, that's a big question, a really interesting one. If the dollar's global role were to genuinely diminish over time, how would that change gold's behavior? Would that inverse link hold, weaken, change entirely?
Something to think about, right?
Yeah.
Beyond the immediate price moves.
Absolutely. And it really encourages you, the listener, to dig deeper. Look into those indicators, follow central bank actions, watch global events, and start forming your own informed views on how these powerful forces might shape things in the years ahead.